Hello, everyone. Good morning and good afternoon, and welcome to Armanino's Essential Tax Insights to Avoid Penalties and Fuel Your Growth webinar today. Really appreciate everybody joining today. Just a little bit of background about Armanino. In case you're not aware, Armanino is a top 20 national public accounting and consulting firm. Started about 55 years ago with over 26 offices, over 3,000 employees coast to coast. So we're really excited to have you join us today to learn a little bit more about specialty tax areas here. So just some housekeeping things real quick. If we go to the next slide, this is the Zoom webinar here. Hopefully everybody is accustomed to using Zoom, where you can use the Q&A feature, chat if you have a question to our hosts and the panelists. And feel free to raise your hand if you're having technical difficulty or need anything else, and a member of the team will get right to you and address whatever your needs are. Move on to the next slide, please. My name is Jason Woon. I am a partner in our valuation and financial modeling practice. I happen to also sit on our firm's technology industry leadership team, which is our largest industry focus, and co-lead our emerging growth technology practice. Emerging growth companies are a highlight of the firms, given our Silicon Valley roots. And so I'm joined by four of my esteemed panelists and partners. We're going to talk a little bit today about different tax insights. So they'll each introduce themselves at their respective sections, but just briefly, Yoon is a transfer pricing partner based in Silicon Valley. There's Stephanie Shorkley and Malcolm Ellerby, who are going to be talking about state and local tax. Stephanie's going to be focused on income tax and Malcolm on sales tax. And then Tom Pivich, who will also chat about R&D tax credits today. Our agenda, if you move on to the next slide. I'm sorry, our learning objectives, hopefully, when you registered, you're aware of that. We've got a nice little surprise to talk first about the One Big Beautiful Bill proposed act, but we'll focus our time on international tax, state and local tax, and R&D tax credit issues. So then I think the next slide is our agenda. As mentioned, we'll start first with the One Big Beautiful Bill, and then you will kick us off with international tax and transfer pricing issues. You'll notice here that we're really looking at, I'll call it specialty tax areas. These are areas from our National Tax Office. Things like corporate tax and other individual tax issues we can address separately. So if you have any specific questions, feel free to use the Q&A section, and one of us will get back to you right away. Okay, you can move on to the next slide. So let's talk first about the One Big Beautiful Bill Act. This is the one elephant in the room. So as you may be aware, if you could go back a slide, Brendan. Thank you. The One Big Beautiful Bill is a budget reconciliation bill recently passed by the U.S. House of Representatives on May 22nd, 2025. So the bill encompasses a wide range of policy changes, from tax reforms to spending adjustments and modifications to federal programs. Well, there are a wide range of tax implications. We're going to cover the most impactful and relevant updates that may affect you. So I'm first going to turn it over to the next slide to me.
Hello, everyone. Good morning. My name is Nhi Nguyen, and I lead our transfer pricing practice here at Armanino. It's a pleasure to speak with you guys this morning about this webinar. As Jason mentioned, first of all, I'll just touch on some key highlights on this One Big Beautiful Bill. I've heard on the radio, people say that it's either one big bill or one beautiful bill. It depends on what side of the fence, I guess, you're coming from. But as it relates to just the international tax highlights, the goal of the One Big Beautiful Bill was generally to make permanent all the tax provisions of the 2017 Tax Cuts and Jobs Act, including lower rates for individuals and international corporations. And that particularly relates to guilty, biddy, and B. And I'll talk a little bit more about what all those acronyms mean. But generally, the bill was intended to make permanent the tax provisions from 2017, specifically to guilty, which is the global intangible low tax income. FDII, I call it FDII, some people don't like that, but that's the foreign derived intangible income. And then lastly, BEAT, the based erosion anti-abuse tax. These provisions would have, automatically resulted in increase in taxes for years after 2025 if an extension would not be in place. And so a lot of, corporations are excited that these, if the bill goes through, they would make permanent these, lower tax provisions. Secondly, what under the international tax provisions is the 163J, which talks about interest expense limitations. Under the current law, from 2022 to 2024, the deduction for business interest expense is generally limited to 30% of adjusted taxable income. Now, from 2022 and onwards, it is calculated after deducting depreciation, amortization, and depletion, meaning these deductions actually reduce your adjusted taxable income and makes it harder to deduct interest. Now, the bill proposes that for 2025 through 2029, your adjusted taxable income will be computed without regard to depreciation, amortization, and depletion, which is a benefit for corporations because that means your adjusted taxable income will be a lot higher because those deductions are added back. As a result, your interest expense limitation will be less restrictive and allowing businesses to deduct more interest. This proposal obviously is favorable for a lot of our capital intensive businesses like manufacturing, energy, real estate, since they have large depreciation and amortization expense. It increases cash tax savings by allowing greater deductions of interest for corporations. Now, the real zinger in this one big beautiful bill is this new code section 899. Everyone is talking about it. It's what we call, code name the revenge tax or retaliatory tax against foreign countries that have implemented what, the Trump administration has called an unfair foreign tax. And that applies to all the U.S. persons or certain foreign entities owned by U.S. persons. The actual title of Section 899 is Enforcement of Remedies Against Unfair Foreign Taxes. And it gives the White House the power to levy a tax up to 20% on foreigners with U.S. investments. They would increase tax rates on individuals and companies from countries whose tax policy the U.S. has deemed to be unfair. Now, the bill is being considered by the Senate, and under the bill, it names unfair taxes such as digital services taxes, which has been threatened to be imposed by, Canada, the UK, and a lot of European countries. It also includes the diverted profits tax, which is in place from the UK, and the undertaxed profits rule, or the UTPR, which is part of the Pillar 2 global minimum tax. And these are taxes that the White House administration has perceived as unfair taxes. I'll talk about Pillar 2 a little bit later on and how this plays, how the interplay with Section 899. So obviously, if this goes through, there are ramifications. There have been discussions that, certain foreign governments will no longer invest in the US. So everybody is trying to understand if the tax implications, if this does go through. This increase in the taxes would apply to effectively connected income, branch profit taxes, private foundation income, and withholding taxes. The specified rate of tax, including applicable treaty rates, would increase annually by 5 percentage points, but capped at 20%. So for example, if you are a Japanese investor, you might have to pay 30% instead of the current 10% tax. And it would just put pressure on a lot of the foreign countries that are imposing digital services taxes on large US technology companies. Obviously, this is the Trump administration's, I guess, countermeasure to all the Pillar 2 discussion, because as you guys are aware, the Trump administration is not on board with the Pillar 2 global minimum tax. The Trump administration has threatened to cut, funding from the OECD, and the OECD, the US is currently the biggest funder of the OECD, contributing to 18.3%. So obviously, the Trump administration is using everything in its toolbox to combat this Pillar 2 global minimum tax, introducing this new Code Section 899 tax as another tool to fight the Pillar 2 global minimum tax. Those are just some of the key highlights I wanted to bring up as it relates to international tax. I mean, for the most part, it was, as expected when it comes to extensions of the foreign provisions, but the zinger was the Section 899. So it's going to be interesting times, as always, to see how that's going to get played out.
All right, thanks, Nee. Hi, everybody. I'm Stephanie Shorkley. I'm a partner in our state and local tax team. I work remotely, but I'm close to the Chicago office. So, Armanino, as Jason mentioned, is spread out across the country now, and I'm kind of in the Midwest. With the one big beautiful bill being a federal bill, right? There aren't a lot of state topics addressed in there, but there are a few things that kind of come up in the state realm that I wanted to talk about today. One of the big items that people are talking about is the increase in the state tax deduction. So currently, your state taxes are limited to a $10,000 deduction on your individual tax returns. This would increase that to around 40,000. There's some numbers with adjustments and inflation and things, and it's capped if you make $500,000. It phases out after that, but the cap currently is around $40,000. We'll see. I've seen a lot in the news about how they're trying to reduce that because it is a big they'll lose a lot of revenue by increasing that cap. So it might come down from that, but that's around what it is currently. The other thing that's kind of related to that is, so when they imposed the $10,000 state tax cap, and that's for income tax, sales tax, and property tax, a lot of states provided a workaround so that individuals could still receive the benefit of the tax deduction. And how they did that was, if you were a partner in a pass-through entity, the pass-through entity would take a deduction on its federal tax return, and it would pass down less of that income. Sorry, they would take the deduction for the state taxes paid. So the entity would pay the taxes in the separate states. Then that would allow for the entity to take a deduction on its federal return, which could exceed the cap, and then it would pass down lower amounts of income to its partners. There's around 30-ish states or states and cities that have done this workaround. A lot of people call it the pass-through entity tax, or PTET or PTET. So this would limit, so because of the cap and because of the workaround, now the bill is trying to address those limitations and saying, some types of businesses wouldn't be allowed to do these workarounds. Some types of income might not be eligible for the workarounds. So I think more to come on that, but they are trying to kind of combat this workaround from the limitation and make sure that everybody is subject to the $40,000 limitation. The other thing that doesn't impact tech businesses as much is, but thought I'd mention it, is that there is this federal law called Public Law 86272. And what that does is that says if you are only soliciting sales of tangible goods in a state, and you're not doing any activities that kind of exceed just the pure solicitation activities, you are protected from income tax in that state. So if I am, basically just shipping t-shirts from California to Kansas, and I don't do anything else in Kansas except for that kind of third-party transit delivery of t-shirts, then I would not be subject to income tax in Kansas. A few years ago, the Multi-State Tax Commission came out and said that certain internet activities could exceed the protections of Public Law 86272. So if you had certain things on your website, you're putting certain cookies on your website, you were able to upload a resume and things like that. So certain internet activities would exceed the protections of Public Law 86272. So they were trying to kind of evolve Public Law 86272 into current times with, computers and the internet and all of that. But that kind of limited the protections of Public Law 86272. In order for those kind of internet activities to be adopted by the states, each state would have to specifically adopt those provisions. So a few states that have tried to do that are California, New York, New Jersey. What they're trying to add in with this language in the big beautiful bill is they're trying to say that those internet activities and some other activities shouldn't exceed the protections of Public Law 86272. So what the bill is trying to do is expand the protections of Public Law 86272, where more recently they've been trying to restrict them. So again, more to come on that. The language in the bill is pretty vague and it doesn't really kind of answer any questions or address anything specifically, but it seems like they're trying to protect Public Law 86272. So that's kind of the three highlights from the bill from a state perspective. And I think now Tom's going to talk about R&D.
Yeah, thank you very much, Stephanie. Appreciate it. Yeah, so as others have mentioned, obviously there's been a couple of specific updates through the One Big Beautiful Bill regarding the R&D tax credit. So I'll talk about that today. So my name's Tom Pevich. I'm a tax partner in our national office. Focus 100% of my time on calculating and defending R&D tax credit claims for our clients, as well as calculating Section 174 studies for our clients as well. So you know. Big beautiful bill, as we mentioned, it did pass the House of Representatives. As Nee mentioned, we do expect further markup still from the Senate, so it still needs to be signed into law. But it has passed the House so far, and still needs to be voted on by the Senate. And again, there's really two provisions in this bill that are relevant in the R&D tax credit Section 174 realm that I'll talk about. And probably the most pressing and most important is the bill allows for immediate deduction of R&D tax credit expenses again for all domestic costs starting in 2025 through 2029. So everything previously before the Tax Cuts and Jobs Act pre-2022, you're able to deduct those R&D costs as incurred. So we would revert back to that regime. So again, simple example is if you had $10 million of qualified R&D spend, you could deduct those costs immediately if they're all domestically based, right? So it goes back to immediate expensing. There is the provision that if you did want to more closely follow, your book or gap treatment, you are allowed to continue to amortize these costs as they're placed in service over a period of over 60 months or 5 years. Again, if you want to limit your book to tax adjustments, that's still an option. But obviously, most companies have chose to immediately expense these costs as incurred. So we revert back to that for 2025 through 2029. We may be having this discussion again in 2030 again if this does pass, but it does allow for that relief for that time period. Unfortunately, this is only for domestic costs. So if you do have any foreign R&D costs where you're paying like an outside contractor or you have employees that are based outside the United States and they're doing R&D work, you'll still need to continue to amortize those over a period of 15 years. So that remains unchanged basically from the Tax Cuts and Jobs Act bill that required the amortization over 15 years. So again, that example that I provided before, if you had $10 million of qualified R&D spend and it was all foreign, that would still be required to be amortized over 15 years. So no immediate deduction there. So now, again, as I mentioned, this will still need to be marked up and probably still further debated. So there's a possibility that this could change, but it does seem that it has unilateral support on this. And again, as it being a budget reconciliation bill, it wouldn't need any support from Democrats, so Republicans could push it through just with the numbers that they have in the Senate right now. So a pretty good chance, so again, that we think this goes through and this remains unchanged, but again, this becomes a bargaining chip as other things change. Certainly with the SALT deductions and other things, this could change. But again, we think it has support to continue to get through. And I think overall, I think the big takeaway here is that obviously this should allow for improvement of your cash flow, right? And so instead of getting those, ultimately you're getting those deductions, but they're spaced out over a period. Now you're going back to getting those immediate deductions, which should help improve tax flow or reduce your tax rate, improving cash flow. Again, this would be for domestic costs only, foreign unchanged. So we'll continue to monitor this. And again, we'll hopefully this passes. Again, we feel confident that it will, but again, it's always a revolving door with these policies. So, then go to the next slide.
Yeah, I
And
think
I
you're
think
going
we're
to take us, into the international tax and transfer pricing issues. Kick it away.
Right. So, well, as part of our the objective this is webinar is just to provide guidance with for companies as you're expanding overseas, how to achieve a sustainable and effective tax rate, and a lot of that has to do with your global footprint and the type of income that the companies are earning overseas. So first of all, achieving effective and a sustainable tax rate, it's a goal for a lot of companies. It's a strategic objective because it's not just a tax department goal. Tax expense after typically ranks high behind cost of goods sold, SG&A expenses in terms of total corporate costs. So there's a real value in managing your tax rate effectively. Ultimately, having a lower effective tax rate improves net income and it boosts your earnings per share. So how do companies achieve effective tax rate? That all comes down to the type of income, the mix of income, and the sources of your income. So one of the most powerful levers for sustainable effective tax rate deduction is your mix of income. Your income earned in like lower tax jurisdictions such as Ireland or Singapore has a direct, obviously favorable tax impact on your global tax rate compared to high tax countries like Germany or the US. That means like locating certain functions, operations strategically will have an impact. And you can do that by managing your IP, determining where your manufacturing locations are and where your services are being performed. And then also another important part is just the business itself, right? What type of income your business is generating. Sales income versus service income versus royalties, interest, and capital gains all have very different tax treatments. So for instance, royalties and passive income are generally taxed under subpart F or GILTI in the US, while operating profits are not. And some types of income, like the foreign derived intangible income, can get preferential treatment, which is great for a lot of US companies, if that applies. And active income, such as income earned from your operations, like manufacturing services, tend to be more tax efficient, whereas passive income, like interest or dividends, they're vulnerable to subpart F inclusions, withholding taxes. So those are just some different various treatments of income a company needs to consider that can have an impact on your effective tax rate. And obviously, you know, being a transfer pricing partner here at Armanino, transfer pricing and international tax planning go hand in hand. You can't do one without the other. So with international tax determines how foreign income is taxed and whether it's subject to US tax or GILTI, subpart F, or eligible for foreign tax credits. But transfer pricing determines where foreign income arises, and by setting the pricing for intercompany transactions across jurisdictions. So what is really beneficial and how we help companies, you know, achieve a sustainable and a really optimal effective tax rate is by modeling. And we work with companies in forecasting what the business incomes looks like by geography, what the functions are, and we'll model the various income allocations across the various scenarios and adjusting for whether you have IP in certain jurisdictions. Ideally, you know, we're helping companies put the IP in an effective location where you have substance, but also it's an ideal location that may have some, you know, incentives to have IP and R&D development activity there. Next slide. So here I'm, you know, just going to get into like a little specifics of how companies can manage their global tax rates. One area is just your legal entity restructuring. And this just involves making sure you're aligning your legal entity structure with your operational and tax goals. And you can by doing so, you can reduce your administrative costs, mitigate risk exposure, and streamline your tax compliance. Companies can also consider shifting activities from your high tax jurisdictions to low tax jurisdictions, such as you're moving your back office operations to jurisdictions that have more favorable tax rates. Another consideration is utilizing hybrid structures, especially you know, when you're going through a transaction, sometimes, you know, having a branch or a disregarded entity to facilitate more tax efficient repatriation of cash and avoid dividend withholding taxes is something that, you know, companies should consider. Or if you have entities with significant losses, then you can consider enabling that loss utilization by putting more profits in that entity with the losses, so that you're absorbing all those losses and, you know, ultimately not paying very high taxes. You can also consider simplifying your transfer pricing flows and improving your transfer pricing alignment by realigning your functional profiles. Taking a look at where your full risk distributors are and maybe perhaps converting it to a limited risk distributor may be beneficial. Another area that, you know, companies should consider is just management fee centralization. A lot of times if we're working with companies that are providing management fees from one entity to another, just a lot of cross charges going back and forth, and we could see 6+ cross charges. You can, you know, certainly make that a more efficient by centralizing all that activity in one entity. Typically that's centralized in an entity with a low tax rate, and so you're pushing a lot of profits into a centralized service entity. And then the key area that is central to planning is just IP ownership. IP ownership is one of the key drivers in managing your effective tax rate. And the goal is to align your IP ownership, like valuable intangibles such as your technology, your trademark or software in a jurisdiction that is both tax efficient, but you have operational substance, which is key. Because under the OECD's rules that were put in place in 2015, you can't just have IP in a paper entity. There has to be operational substance in there. And so, companies, you can consider monetizing IP such as your intangibles, your trademarks, and it can also provide benefit depending on where you are considering having your IP owned. You can consider jurisdictions that are still favorable, like Ireland, Switzerland, and Singapore and the Netherlands, still commonly used. And it's just depending on what kind of treaty you have with that foreign country where you may be putting IP in, and that's something to also consider. And I know, Tom touched about this, but another area that companies also look at that's really important to managing your effective tax rate is R&D credits and R&D incentives. That can help determine where you put your R&D activities in foreign jurisdictions. So countries like the US obviously has, your R&D tax credits. The UK also has one. Canada, Australia has known for their R&D tax credits that are some are refundable, some are not refundable. So those are incentives that a lot of our clients have taken advantage of. You should also consider like super deductions. Certain countries also have these super deductions. And these are great incentives that, can help reduce your overall effective tax rate. Along this line, you should also consider like patent box regimes where certain qualifying tax, it would reduce the tax on certain qualifying income, obviously contingent on where that development is taking place. And lastly, we also want to talk about the use of treaties. Depending on where you are going to expand your global footprint, one of the questions that that arises, where should we enter into? And that could be also contingent on what type of treaty the US has with that foreign country. So obviously, like countries like Singapore, we do not have a treaty with Singapore. So there are some withholding tax associated. Even though we have treaties with Canada, there is a withholding tax on royalties. Similarly with Australia, there's a 5% withholding tax on royalties. So these are just all parts, that companies need to consider as they're expanding their global footprint. Lastly, I just want to talk about, well, I gave you all the, examples of, how to manage your global footprint and also your effective tax rate. But some of the challenges to planning also has to do with the fact that with, post TCJA, there are some limitations on how far your effective tax rate could come down to. Obviously, we have in place now what we call this global intangible or GILTI, which is effectively the US's global minimum tax. We also have BEAT in place, and BEAT is just a tax when you have a lot of transactions or payments overseas. And so those are provisions international tax provisions that have been put in place post TCJ that it does impact or create some challenges to how low your effective tax rate can come down to. And Pillar 2 is something that is also, in discussions, and it's been in place and been implemented already. So under Pillar 2, it's been implemented in over 130 countries now and introduces a global minimum tax of 15% for certain multinationals that have turnover more than 750 million euros. And this is essentially done to prevent, countries from having really low corporate tax rates in place, prior to Pillar 2. companies could have countries like Australia, Italy, and Sweden are implementing now, but prior to Pillar 2, companies had global, tax rates of certain income was at 0%. And so obviously those days were gone. So I wanted to also just briefly touch on, GILTI. As I mentioned, this is the US's effective global minimum tax, and the US is the Trump administration is trying to demonstrate that the US does have a minimum tax and demonstrate that to the OECD, because obviously they have not signed up for Pillar 2. Next slide, I just wanted to go through really quickly, give you an example, a table of what does the effective tax rate look like for your leading technology companies. The top few companies, those are service companies, and service companies generally have higher tax rates because a lot of their income just earned in higher tax jurisdictions, and it's just really difficult to go about with planning in terms of profit shifting and utilizing any credit or R&D credits just because of the nature of the business. And I wanted to point out Apple. A lot of people would think Apple would have a very low effective tax rate with all the planning. In 2023, Apple's tax rate was 14.7%. It did spike up in 2024 because of the one-time tax charge of $10.2 billion from the European Commission state aid decision, which found that Ireland had granted Apple illegal tax advantages. So otherwise, apart from that one-time charge, Apple did have a relatively low tax rate, and it was in line with your other large technology companies like Google and Oracle. So I just wanted to share a slide with you that effective tax planning, rate planning is not dead. It's just there are some challenges, but obviously still something for companies to consider. And now I will pass it along to Stephanie and Malcolm.
Hey guys, I'm going to talk about state and local tax. I'm going to cover income tax and kind of some non-income taxes that are similar to income tax. And then Malcolm will jump in with sales tax. So Nexus, so just to start off, Nexus has always been a big thing with state tax. It's basically the contact with the state that gives the state the right to tax you in that state. We've seen a lot of businesses who were only in one state or one or two states kind of really increase their state nexus profile in the past few years, and that's due to a couple of things. So the two standards for physical presence two standards for nexus are physical presence and economic presence. So with COVID, we saw our physical nexus expand for a lot of our clients as people started working remotely. So the remote workforce has really expanded the tax filing profile for a lot of companies, because those people or property in that state are going to give you a requirement to file a tax return in that state. The other thing was Wayfair. So Wayfair was a sales tax case, Supreme Court case, that basically established economic nexus for sales tax purposes. That has been expanded to income tax in a lot of states. And that says the state can tax you if your sales exceed a certain threshold. So prior to Wayfair, most all states had some general economic nexus provision saying, you have nexus in the state if you're doing business in the state, or you have sales derived from the state, but that was largely unenforceable until after Wayfair. Since Wayfair, a lot of states have come out with a threshold for what that nexus threshold should be. So it'll, for income tax purposes, it's typically 500,000 of sales into the state will trigger a filing requirement. For those states that have a bright line nexus threshold, there are a few states that have a lower threshold, like Michigan is 350,000 of sales, New Jersey is 100,000 of sales, but in general for income tax, it's mostly 500,000 of sales. So because of Wayfair was a culprit, and again, the remote workforce has been a big influencer of where companies now need to file. So a lot of what I do at my job is kind of look at company fact patterns. Where do they have physical presence? Where do they have sales? And kind of determine whether you have nexus or not. Because it's for income tax purposes, it's a little complicated. The other thing that we consider when we're looking at nexus and when we're thinking about states and state taxation is apportionment. So for sales other than tangible property, like SaaS or services or virtually transmitted software, intangibles, things like that, the states are going to source your sales based on one of two methods. One is called market sourcing, and one is cost of performance. So with market sourcing, the states are going to look to where the benefit of the service is received. For cost of performance states, they're going to look to where the cost to perform the services were incurred. And that can be done either on a proportional method or a greater proportion method. So in a proportional method, they'll say 10% of your costs were in this state, so we're going to source 10% of your revenues to the state. In a greater cost of performance state, they're going to look to where the greater proportion of your costs are. So if the greater of your costs are not in a greater proportion state, then typically you have zero sales source to those states. It depends on the state, but that's kind of what we're looking at. Where are your costs? Where's the benefit being received? Key costs for service companies and a lot of software companies are payroll. So sometimes payroll is used as kind of a proxy for cost, but other costs can be incorporated in those cost performance. Most states are trending towards market-based sourcing. Again, that looks to where the benefit of the service is received. And that's just because it gives a, kind of more of a accurate spread of where your sales are incurred. Lately, we've seen a lot of opportunities with sales sourcing and nexus. Okay, so sales sourcing or nexus. So the opportunities typically come from looking to where your costs are incurred or where the benefit of that service is received. For California, they're going to look through to the ultimate beneficiary of the service. So for sales sourcing for a SaaS product, they might not look to the first user, they might look to the end consumer. So historically, we've seen a lot of companies sourcing their sales to the headquarters of a certain company. Like, we sell a software to Google, and we source that sale to Google's headquarters, when California would say we should probably source that sale to Google's employees or wherever the ultimate user of that software is. So we've seen a lot of opportunities there. The other thing that's important to consider is that all the different states have different rules, which makes my job very fun and interesting. So because of that, there are instances where you could have more than 100% of your sales sourced to the different states. For instance, if you're located in a greater cost performance state, that could end up with your sales being more than 100% sourced to the different states. And you could also have it where you have these nowhere sales. So you have sales to certain jurisdictions where you don't have nexus, you don't have a filing requirement, and so they kind of go nowhere. You could also have sales to cost of performance states where you don't have costs in those states, and those are nowhere sales. For sales other than tangible goods, those sales do not need to be thrown back to the home state. There's one or two states with a throw out rule, which would throw it out of the denominator, but in general, you're going to see a benefit. that's, that's where we see a lot of opportunity, is looking for where you need to file. Should you be apportioning? Where should those sales be sourced? There are some pitfalls associated with that. And one of those is, or with apportionment and sales sourcing, with a lot of pre-revenue companies, we see a lot of people apportioning their NOLs 100% to California. Whereas if you do nothing and say they have employees in 10 different states, where that could become an issue is you are supposed to be apportioning your income. California is a single sales factor state. You don't have any income. So effectively, your percentage should be 0% instead of 100%. So we've seen some overstated NOLs based on the right to apportion and kind of apportionment. There are some ways to work around that, but it is something to be thinking about for your provisions and for your future, post revenue, when you're making money, time period, and, as you're thinking about the year and what's coming ahead. That's kind of the pitfall of the NOL. That's why NOLs are on there. But the other thing to think about is I've heard a lot of companies say, I'm at a loss. All my employees and property are in California. Why do I care about filing somewhere else? And that can also lead, so they're still apportioning 100% of their NOLs to California. That can also lead to overstated NOLs. It could also lead to understated state tax liabilities in other states. So if you go to the next slide, I'm going to talk about non-income taxes. So non-income taxes are, as it reads in the title, not based on income. So if you have receipts, you could still be subject to that tax. And it doesn't matter if you're in a net operating loss or not. If you're in California, a lot of California jurisdictions have these non-income taxes. A big one for a lot of our clients is San Francisco. San Francisco has a gross receipts tax. It has an economic nexus threshold, and it's also undergoing a lot of changes. So even if you've been filing that and are compliant, there are a lot of changes happening effective 1/1/25 that need to be considered for, for planning purposes and also for your estimated payments. The next estimated payments due in July. So think about through the changes and how that's going to impact your San Francisco filing. And then, like I said, there's a number of local taxes in California. There's also local taxes in New York and Philly and some other states. So local taxes might not be based on income and might have a filing or might have a tax liability associated with them. There's some non-income tax states. Washington has a B&O, which is based on receipts. Ohio has a commercial activity tax, which is based on receipts. Texas's tax is based on margin, so it's a little bit of a different calculation. And then there's other states that have franchise taxes that you could also be subject to, and you would have a tax liability even though you're in a loss. So just some things to think about. And then I think Malcolm's going to talk quickly about sales taxes.
Yes, thank you, Stephanie. Now we get to the thrilling part of the presentation, sales tax, that's right. And actually, that's not a joke. For SaaS companies, sales tax can be thrilling and not always in a good way. I've been doing buy-side and sell-side due diligence for cloud-based services, including SaaS, for many years. And it's the same movie we see over and over. So very briefly, I want to highlight that in case, that's been on your mind or you're not familiar with the issue. Once you hit between 5 and 15 million ARR, SaaS company, three things happen. You graduate from QuickBooks to Sage Intacct or some other ERP. You get your rev rep together, your 606, to make your auditors happy. And if you know better, you clean up your sales tax so that when you go to sell that company, as you approach 20 or 25 million, PwC or whomever doesn't come in on the buy side and say, by the way, we want to escrow $1.5 million for uncollected sales tax. So the best way to avoid those surprises is a straightforward evaluation. Where do we have nexus, where we meet the threshold, 100,000 of sales usually, or headcount, right? Employees, physical nexus. And where SaaS taxable? Got to have both of those to have a liability. Then we will run a prior period liability calc back to your first nexus in those states. That's how you derive the exposure. So if you still have time to clean it up before the transaction, in the states where it's material, you can do voluntary disclosure agreements, VDAs. The state is going to want their tax and interest, but they'll waive penalty and they'll limit your look back period to 3 or 4 years. That's a good thing. If you don't have time to do that, at least you are the one preparing that analysis and not, EY on the buy side. They're going to be very conservative. So you want that study in the drawer, and then it's up to the parties to decide who's going to do the remediation post-transaction. Last comment is regarding taxability. A lot of my cloud-based services clients now have a mix of SaaS and pure services, but it's for a single subscription price. That's called a bundled transaction. And if the non-taxable services are not small or incidental, and it's bundled in with taxable SaaS, it'll taint the whole transaction. So that's tax you can be collecting from your customer and not hitting your balance sheet because you're not collecting it. I'm going to pass it over to Tom.
Thank you very much, Malcolm. I think I'm still trying to go on video here. Oh, okay, here we go. Oh, it's not working. We'll go. Oh, there it goes. Okay, sorry. Thank you very much, Malcolm. I appreciate the overview. So I'm just going to talk about a couple of recent updates on the R&D tax credit side outside of pure our big beautiful bill. These are just recent legislative changes and recent tax form changes. So as part of the Inflation Reduction Act a couple of years ago that was signed in by President Biden, there was a change. Previously, you could use up to $250,000 to offset your payroll tax liability using the R&D tax credit if you're considered a startup company. And you were deemed a startup company if you had less than 5 years worth of gross receipts and you had less than 5 million in gross revenue or gross receipts for the year. So you had to be around less than 5 years and have less than 5 million in gross receipts in order to be payroll tax eligible. So then you could utilize that R&D tax credit to offset any payroll tax liabilities you had in your 941. Well, up until a couple of years ago, you could only use $250,000 per year to offset your payroll tax liability. And it really only related to the FICA portion of your payroll tax liabilities on your 941s. So that's 6.2% basically you're paying on behalf of your employees. So, and then obviously as part of this Inflation Reduction Act, it was actually increased to now $500,000. And it not only took into account the FICA portion, but also Medicaid and Medicare. So that remaining 1.45% portion that was previously not eligible is now eligible. So long story short is you can deduct up to $500,000 and it's $250,000 for the FICA portion and $250,000 for the Medicare and Medicaid and Medicare portion. So that is a significant change, and certainly has been beneficial for startup companies because they're able to been able to double their payroll tax eligibility. So that's one significant change to kind of make you aware of. The second change, and we can go to the next slide here, would be starting for 2024 tax returns. The reporting requirements around your Form 6765 have changed. So there's a couple that are mandatory in 2024. And then that are optional in 2024 that then become mandatory in 2025. So it's part of where the Form 6765, and we kind of covered this already, but for your payroll tax filing, you just file in your 941 and the quarter filing your tax return. So sorry, I jumped ahead a slide here. We can go to the next slide here. But the next change I kind of want to talk about, I briefly started on, was the form reporting requirements on your form 6765. Some of these are again optional changes in 24, but then become mandatory in 25. So there are some mandatory changes that are required in sections E and F on your form 6765. It basically asks you to identify how many qualified business components you have or qualified projects. Also, it asks you to identify if you're claiming any officer's compensation um, as part of your R&D tax credit, and also if you're a control group member or part of a control group member of a larger control group. So those are some of the mandatory requirements that are 24. Um, and then moving into 2025, we'll talk about this. If you have basically more than 1.5 million in qualified research expenditures or have greater than 50 million in qualified research expenditures, these requirements are optional in 24, but then become mandatory in 2025. And really the big change is that you have to identify obviously all your qualified business components, and then you also need to put a description in of what those business components are or qualified projects. So a high level summary of what the goal of the project was, what the technical challenge was or uncertainties, and kind of what the process experimentation was taken on those projects. And those actually need to be included as an attachment in your form 6765. So you get kind of a 1 year reprieval on this for 24, but then again, if you're hitting me on those requirements of 1.5 million more in gross receipt or in qualified research expenditures or 50 million in gross receipts, they become mandatory in 25. As a part of this, you'll also need to identify, again, if you had qualified research expenditures for wages, supplies, or contract research payments, you're also going to need to create a nexus between those qualified costs and those business components that we talked about. So it wants to know if you have 2 million in qualified wages that you're claiming for the R&D tax credit, how did that 2 million break out in terms of those projects, right? So you're going to need to create a nexus to show how the qualified business components are related to your wage, supply, and contract research costs, right? And then as well as that we talked about earlier, you're also going to need to have the description for those projects as well. So it's just going to be a significantly more reporting requirement, and that it become mandatory in 25. So if you've previously just been doing very high level calculations where you're just identifying qualified research expenditures by percentages and not really identifying them by projects or by employee vendors or by contractors or vendors, you're really going to need to start doing that again in 24, and then it's going to be mandatory in 25. And then you're also going to need to put descriptions down for what those projects are as well. So again, and this is all going to be required on the form. So this isn't something where you can just kind of focus on the quantitative side of getting your calculation done and file a tax return and then kind of backfill all the information after the tax return is filed. It's going to need to be done contemporary. So you're going to need to submit all this information as part of the form 6765 as your actual tax return is filed. So can't be done months afterwards, and it has to be done contemporarily. So those are just two of the major changes that have taken effect in the past couple of years in terms of the R&D tax credit that they should be certainly aware of. So, and I think with that being said, I think we're maybe have a couple minutes for questions, but I just wanted to thank everyone for their time today and greatly appreciate everyone reaching out and listening to us today.
We had a few submitted questions. I think we covered pretty much most of them throughout the presentation, so I didn't stop. If we didn't, we will follow up directly with whomever submitted them. So thank you for participating. Other than that, we don't have a lot of time, so I want to be respectful with everyone. So I wanted to thank all of my partners for presenting today. There was a lot covered. We really just scratched the surface. You can see how state and local R&D and international tax, especially transfer pricing, are all complex issues. So please reach out to us. And that will conclude. I think if we go to the final slide, we just have one more thing, and that'll conclude our presentation. So thank you for everyone. Have a great rest of your day. Take care.